When the next crash hits, 99% of people that are using margin are going to panic, and I will be calm. Most people think that margin is gambling, but I think it's the smartest wealth building tool that nobody actually understands. And by the end of this video, you will know everything you ever need to know about margin to never worry about getting margin called. At this point, you're wondering, but why should I listen to you? Well, 4.5 years ago, I started from zero, and then I've grown a $775,000 portfolio safely by using margin. To stay safe with margin, first, you need to have an understanding of what it is and how it works. There are really only 5 things that you need to know about margin, anybody, that you can use as a last resort. But first, make sure to like this video. Here are the 5 things that you need to know about margin. One is it's the most powerful but dangerous loan type available to consumers. Two, it's a loan backed by your stock portfolio. Three, there's no credit check. Four, it's an interest only loan. And five, there's an infinite payback period. Why is margin the most powerful loan type? You can borrow half the amount that you have invested and you get the lowest interest rates available to consumers. But it doesn't come without risks, which we're going to dive more into in just a minute. Two, your loan is backed by your stock portfolio, meaning that your stock portfolio is just collateral for the loan. Your brokerage will give you up to half of your total portfolio value in margin, meaning that if you have $100,000 invested, you can borrow $50,000. But it's actually a lot cooler than that. If you use this money to buy more shares, since you just bought more shares, your total portfolio value goes up by the $50,000 that you just borrowed, which means that now you can borrow half of that right away, meaning that you can borrow another $25,000, which you can then use to buy more shares. While this is very powerful, if you don't set some rules for yourself, you can get into a lot of trouble very quickly. And at the end of the video, I will go over some of my rules to stay safe. Make sure that you understand how your brokerage calculates your loan to value ratio, and don't let your margin health or meter go to 0%. In M1 Finance, they make it incredibly easy to know just how far you are from a margin call. Real quick, if you are using M1 Finance, you just click borrow, margin on Pi, and you have this fancy little meter here that tells you exactly how far you are from a margin call. Three, there's no credit check. Your credit score is completely irrelevant when you're using margin. It doesn't matter if you have perfect credit or no credit. The only thing that matters is the value of your portfolio. Four, interest only. If you were anything like me growing up, you were likely taught by your parents and teachers that interest only loans are a bad thing. But that's just a lie that keeps the middle class stuck in the middle class. And while they probably had good intentions when they told you this, they just didn't understand why interest only loans are powerful. Interest only loans are the best type of loan. Let me explain. With interest only loans, your total monthly cash flow is much higher. The most common type of loan is principal and interest. And honestly, these loans favor the banks more than anyone else. Your monthly payments are much higher than if you were to use a interest only loan, like with margin, which means that you have less cash in your pocket today right now. Let me ask you a quick question. Is cash more valuable today or in a year from now? Today's cash is much more valuable because the government prints more money, which means that yesterday's dollars all become worth less and less. With an interest only loan and more cash in your pocket today, you can use that cash to invest and become one step closer to retiring early. Five, infinite payback period. You never have to make another principal payment, ever. You just pay the interest as it accrues, which keeps your monthly obligation extremely low compared to any other loan type. There's no due date, no 30-year mortgage clock, no 5-year auto loan countdown. As long as your portfolio stays above the maintenance threshold, you can hold that loan forever. And that is exactly what makes this loan so powerful for long-term wealth building. Now, I'm not saying that you shouldn't make payments to get the loan balance down. I'm just saying that you're not forced to make payments. And the longer you can hold this debt, the longer that you have the spread on your interest rate of borrowed money versus the invested money working for you. Okay, that's everything you need to know about margin loans. Now, how do you avoid getting margin called? Really, there are 5 ways to avoid a margin call. 1, an emergency fund. 2, a paid off car. 3, a HELOC. 4, hedging. And 5, the bonus option. This one is foolproof, and you will never get margin called with this option. Your emergency fund. So you could just have an emergency fund of 6 months or so sitting in cash or SGov earning interest. But this one is my least favorite option because you're giving up huge potential upside in returns by choosing to not have your money invested. 2, paid off car. This one is different for everyone because depending on how old your vehicle is, the condition of your vehicle, the age, and the miles, your vehicle may not be worth very much, or it may be worth a lot. This one is kind of a wild card. But if your vehicle is paid off, you can just call up the bank and tell them that you want to borrow money from your paid off vehicle. You can use this money in case of emergency to pay down your margin and get it back to a healthy loan to value ratio. This can help get you out of trouble if you're close to getting margin called. You could also use this money to buy more shares like I did back in 2022. 3, HELOC. If you have enough equity in your home, you can open a line of credit that sits there silently waiting to be utilized. This is known as a HELOC. It's a revolving line of credit and it works in the same way that margin works. Typically, it has a little bit higher interest rate, but if you have a HELOC, I think that this is one of the best type of emergency funds to lean on if you're using margin. A HELOC can give you anywhere from up to a couple thousand up to a couple 100,000 in equity to borrow from. Wealthy people don't just sit there and save cash to hoard. They're using lines of credit, meaning that they're going to have several lines of credit open. They might have margin, HELOC, maybe the ability to use a paid off car. And if they need to, they can just borrow from one line of credit to pay off another line of credit or kick the can down the road a little further until the asset class goes back up in value. That is the main idea of the wealthy. 4, hedging. There are different ways that you can short the market, meaning that you're basically buying shares, betting that the market's going to go down in value instead of up in value. And this is going to help cushion your fall as the market's dropping. As I mentioned, there's a few ways to short the market. Here's how. You can keep it simple and you can buy specific ticker symbols that short the stock market. And the simplest way to explain that is that these symbols will move inversely to what they track, meaning that if something they track like the S&P 500 goes down in value by 1%, then the ticker symbol that I'm about to show you would go up in value by 1%. So, here's the S&P 500. On Friday it was down 2.59%. SH stock, if you were to search this in any of your brokerage funds like Robinhood, Fidelity, IBKR, you would see that even though on Friday the market went down, you went up 2.65%. So we have SH, then you have SDS. This is a double leveraged variation of SH, meaning that the S&P 500 went down in value by 1%. This would move up by 2%. Next, we have QQQ. This tracks the NASDAQ, and on Friday, it was down 4.8%. And the ticker symbol that sorts it would be PSQ, which was up by almost 5% on Friday. Then we have QID, which this is double leveraged version of PSQ. So this was up almost 10% on Friday. And I couldn't find it on Google, but finally we have SQQQ, and this is triple leveraged variation of QQQ inverse, which means that on Friday it was up 14% because of the market downturn. Now you could also buy puts, and a put is basically just a bet that something is going to go down. So you pay a small premium up front, and if the market does crash, your put explodes in value. If it doesn't crash, then you just lose what you paid. That's it. Think of it like insurance. It's a small cost with a big payout if things do go wrong. But one catch, your puts do expire, whereas the ticker symbols that I just showed you don't. So you don't have to be right. You just have to be right on time. Think of it like the insurance on a house. You pay a small premium up front, and then if something happens like hail damage, you get paid out. Here's how it works in practice. Let's say that SPY is at $500 and you buy a put at $500. The market crashes to $400. Your put is now worth $100 per share, and you never owned a single share of stock. 3 things that make puts powerful are defined risk, You can only lose what you paid for the contract. That's it. Leverage, one contract controls 100 shares. And 3, you don't need to own the stock. You're purely betting on direction. That's the most simple way to put it. All right, now finally the bonus. This one is foolproof and you're never going to get margin called doing it. But before I share it, seriously, make sure to like the video and leave a comment. YouTubing isn't easy and this helps get these videos in front of more people. Here's the secret sauce. If your margin health gets too low, I'm talking like you're 10% from getting margin called, this is all you do. So let's say that my margin health was 10% and I was just sweating bullets about getting margin called. What you would do in that scenario is you would sell everything in your portfolio and you would buy TQQQ. This is triple leveraged NASDAQ. So on Friday, the market went down by what, 5% for the NASDAQ? This went down by almost 15%. But here's the catch is you can't get margin called with something like TQQQ. And since your shares of everything else has already gone down by so much and you're not triple leveraged, the ride up when the market does correct, you're going to be back maybe even higher than you were before. But you don't want to hold this forever. You only want to hold this until the market is fully corrected. But to give you an idea, in the last year, this has gone up 96%. And year to date, you're still up 40%. It does have something called volatility decay, which I'm not going to get into in this video. But when the market recovers, you want to then sell out of TQQQ and then buy into your original positions. And this is the ultimate way to make sure you never get margin called. So seriously, if you didn't like the video yet, go like the video. The goal here is to get rich 999 out of 1,000 different times, not to swing for home runs every time that you step up to the plate. I see so many people try to get rich and they waste years of their life chasing trends and staying broke. You get rich by getting consistent, solid returns over time and never losing. This is why protecting the downside matters so much more than people realize. Losses and gains are not a one-to-one relationship. A 10% loss doesn't just need a 10% gain to break even. It needs much more than that. And the bigger the loss, the worse the math gets. If you lose 20%, you need a 25% gain just to get back to zero. If you lose 50%, you need to get a 100% gain to get back to break even. If you lose 75% of your value and you sell, you need a 300% gain to get back to break even. You need to 3x your money just to break even. This is why day traders always lose. You're not just recovering, you're climbing out of a hole that keeps getting deeper and deeper. That's why the most important rule in investing isn't just finding the best stock, it's to get consistent wins and to never take a loss. Here are a couple rules that I follow to keep safe from a margin call. Don't do any of these things. No penny stocks, no day trading, no cryptocurrencies, and no individual stocks. These rules all apply in a margin account, and in general, they just apply if you're trying to actually get wealthy. These rules themselves deserve their own video, but if you disagree with any of them, let's talk about it in the comment section. Let me know your favorite part of this video, and make sure to share this with your day trading friend who keeps swinging for home runs. See you next time.